everyone, and welcome back to the channel. In today's video, I'm going to share something really special. So I've been studying ICT since 2021, and if you have been following his work, you know how much he loves to hide things in plain sight. So over the years, I've uncovered a few secrets inside his mentorship, and today I will be showing you my own notes from the brand new 2025 mentorship. It's about learning how to study in a way that reveals what most people miss. This method has completely changed the way I see the markets, and I hope that by watching this, you'll gain a sense of how to approach his materials as well. So honestly, this took me years to figure out, and a part of me don't really want to share it, but the impact that it has on my trading has been life-changing. So let's dive in. Firstly, ICT 2025 mentorship. This is the first episode, trading all-time market highs. So what I like to do is I like to open up the transcript and then just put it on the side so I roughly know what he's talking about when I am looking at the charts. So here are all the 7 points that he have mentioned the day itself. And then he went into the charts to look for examples. So we will not be looking at anything under the daily chart. And whenever you come into the market and looking for your daily buyers, you should always start from the daily chart as well. And here are all the points to look out for when you are in the daily charts. So firstly, when a market is trading at an all-time high, it is more likely that it will continue to post higher all-time highs. So here we can see that we have sell-side liquidity swept. And then the lowest hanging fruit is right here, where the last swing high is formed. And ultimately, when a market is trading at all-time high, it is likely that it will continue, and therefore we anticipate the all-time high being taken as well, which is right here. Okay, so the first example, look for price to trade under the up-close candle, closing prices near all-time highs. Market tends to overshoot previous redelivery in the form of bear traps. So over here, he's talking about the retail trading hour already, where price push lower and everyone else thinks that it's going lower, but it actually rushes up. So I like to put down the timestamps as well of when he's talking. All right, so going into my own chart, as he's mentioning this run lower. How does H1 look when price is running lower, and how does it make people think that it's going lower? So on the H1, we can see that it was this 3rd September candle on a Wednesday. We can see that on New York AM session, ES on the left actually created a lower low, while NQ on the right created a higher low. So this is usually divergence that make people think that price is going lower. But we can see that on the next day, during Thursday, 10 a.m., this is when price pushed lower down into the new week opening gap and then took out this SMT that was formed. Okay, so it's important to mark out the timing of when it formed as well. So we have 11 a.m. New York AM session SMT. And then on the next day, during 10 a.m., that was when we have a rundown, making people think that price is going under this new day opening gap and then going lower, but instead it went higher with this rush up. Okay, so over here I mentioned that the candle that ran lower and then higher is on 4th September, and on 3rd September it gave a SMT at 11 a.m. with ES that did not fall any lower. Then on Thursday 10 a.m., price for both dropped under the low of day, which is under your London session and Asia session for both of them, before going higher across all new week opening gaps. So here's one, and then here's another. Here's one, and here's another. That price went higher. All right, and then next 12:22 timestamp, we see this immediate rebalance where price reached into the high of the previous day's wick, and then it ran a bit lower. So immediate rebalance is typically very strong and is likely to offer discount sensitivity. So here on the H1 time frame, we see that the immediate rebalance happened after NQ and ES took out previous high. So on ES, it took out the previous month's high, while on NQ, it took out the previous week's high. And then this immediate rebalance dropped lower, giving us another divergence between Thursday versus Friday on ES and NQ. So that marks the stop of the run lower. So NQ held Thursday's low, keeping it intact, while ES did not. It took out Thursday's low. All right, and then timestamp 1313. Look for price to trade under down close candles closing price. Rejection block tends to promote new runs higher in price. So here I have the rejection block marked out from this candle, price took it out, and then this is also a rejection block, and this as well, and this as well. So this big wick candle itself is a rejection block. And here I mentioned that the Friday big wiki rejection block candle got retested on Sunday open for NQ, while it retested multiple times on ES. So every time I see a new point that is made from his video, I go into my own charts, hourly time frame, I match it with ES and NQ. So what I can see is that the big rejection block here, marked out on NQ, was only retested once during Sunday open, while it got retested multiple times on ES. So this itself can be divergence too. So after that, I see relative equal highs from Friday, Monday, and Tuesday until the New York PM session. So over here, you can see we have Friday high, and then Monday, and then Tuesday until PM session, where it was all taken out. So next, he talked about grading all premium candle wicks and anticipating the gradient levels to offer discount sensitivity in price. So here we have the first candle with the large wick above its body, and then you can mark out the 0.75, and then you can see how the next few candles constantly come back to all these levels to retest it. So on this candle, we can see that the low reached into 75 while the close was 50%. And then on this candle, we see the low form at 0.5 while the close is near 0.25. And then next one, we have the low being formed at the 0.25 and then the close at negative 50. So what I did is I went into my charts and then I extended the price levels way beyond its zero level. And then I got negative 25, negative 50, and negative 75 all open up. And then we can see that this candle itself has its closure right at the negative 50 level. And then this 50% level that was marked out here also overlaps with the previous week's high, and it left a volume imbalance right here. So the next time it returned to this volume imbalance, it gave us this red bearish candle before running higher with another volume imbalance over here, right at the negative 50 level. Okay, so I matched it with what happened on ES as well. I open up the negative levels and I extend it all the way up into the same area where we got this order block, while price on NQ gave us this volume imbalance. So at negative 200%, we see this order block being created with the closing price lining up perfectly. All right, so ES went into negative 200% and signs of more bullishness when NQ gave the red candle while ES gave a green. Let's call this the SMT candle. So this is the candle I'm talking about. We have a green candle over here while NQ gave the red. So once this was formed, we can anticipate for ES to give us the higher run up while NQ gave us a shorter one, holding right below all-time high, which is also previous month's high. Okay, so at 200%, ES gave a red candle up here, while NQ gave a green candle, which is this one with the VI at the opening as mentioned before. And now, during yesterday's FOMC, which is 17th September, we see how both prices drop into the negative 50 and negative 75 range. So this is on NQ. We see that it dropped all the way down into this negative 50 and negative 75 in line with the volume imbalance. So ES also dropped into the negative 50 and negative 75 range. And it also is in line with the SMT candle that was mentioned before. So this was the SMT candle, the high over here. And then this was the SMT candle, high area. So this is a rebalance. Okay, so this is how I look for confluence at every single thing that he's mentioning. So when I have my bias on the daily time frame, I can go into the lower time frame with all of this level and see how price reacts to them. All right, so now merging with the next premium wick at 1749. I like to include, his transcript over here so I know what he's talking about. I know the background. I know more. And then price specifically returns into this key level when it's trading near or at an all-time high. So now I have even merged, two of the wicks together just to see confluence. So here we can see that the negative 50 and the 25% merge really well, that it gave this, very close price level. And this is what you want to look for. When you see all of this level are being, equally spaced out, then that's not something that I would pay much attention to. But on NQ itself, we see this nice little level that was given, right? 1, 2, 3, 4 days before this FOMC candle was given. So right now, as I am studying this chart, it's 3:54 a.m. Thursday on 18th September, London Q zone. We can see that price gave us this big candle reaching into the whole numbers that was marked out, right? So I've gone a little bit too far down the rabbit hole when you start seeing your charts being like this. So we have reached the end of today's video. Personally, I like to dance on the edge of the rabbit hole with the charts looking like this. And then I'll step back, head to the gym, live my life, and then let the answers surface as my mind relaxes after expanding it like this. So I encourage you to do the same. Be intentional about your studying and be intentional with your rest. So come back to this video over and you'll probably notice anything that you missed the first time. So thanks for watching. If you like more content like this, you can find it on my website, link in bio. So till next time, take care.